Welcome to the Deep Dive. Today we're operating as talk tickers, where we take those, really dense earnings calls and boil them down for you.
We give you the shortcut to what actually moved the market.
And today we are cracking open the Q3 2025 earnings call for Life360. That's ticker LIF.
Right. And this was a quarter that, on paper, was just an undeniable financial victory. I mean, a huge success. But the market reaction was savage.
Savage is exactly the right word. The call was after the close on November 10th. And what we want to do in this deep dive is really explain that massive gap between an incredible financial beat
and the brutal 22% stock derating that followed.
It's a classic story, isn't it? The market choosing fear of what's next over the reality of what's happening right now.
It really is. And to understand that fear, you have to start with the present, because the operational success here was, frankly, staggering.
Okay, so let's start with the financials. These weren't just small beats.
No, not at all. This was a significant acceleration.
So GAAP diluted EPS landed at 11 cents. The consensus expectation was what, 3 cents?
3 cents. So they just absolutely crushed estimates. And if you look at the adjusted number, it's a similar story. 28 cents versus an expected 17.
And revenue backed all this up.
Yep. $124.5 million. That's 34% year-over-year growth. And it surpassed, the top end of the consensus range.
But the real story here, for me, was the leverage. The speed at which they're generating profit.
This is where investors should have been celebrating. Adjusted EBITDA hit $24.5 million.
Which is a massive number, up 174% year over year.
And it beat the high end of broker forecasts by nearly 40%. This wasn't just a small improvement. It's a fundamental shift in their cash generation.
Exactly. And the operating cash flow number was even more dramatic.
Surged 319% year over year to $26.4 million. This is the inflection point. The company is maturing, and it's translating directly into massive cash returns.
So if the financials are that strong, we have to look at the engine, the subscription business. How did that look?
Incredibly robust, predictable. Subscription revenue was $96.3 million, up 34%.
And the core subscription revenue was even better.
Right, up 37% when you strip out the other stuff.
And inside that, the user metrics, all-time highs, right? Paying circles hit 2.7 million.
Which is up 23% year over year. And they were boosted by a record 170,000 net additions just in this quarter.
And they're getting more from each household.
That's the ARPPC, average revenue per paying circle. That was up 8% year over year to about $137. The CEO was clear this was all driven by back-to-school engagement.
Okay, so with that backdrop of just flawless execution, here's the first problem. The MAU figure.
The monthly active users, yes. The North Star metric for their overall reach.
It hit 91.6 million, which is a solid 19% increase, but
some of the high-side analyst expectations were closer to 94 million. And the market fixates on MAU because it signals pipeline growth.
Wait, okay, hold on. How can you have record paying additions, record monetization, but the total user number slightly disappoints? That feels like a disconnect.
It does, but management explained it. This wasn't an accident. It was, and this is their word, an intentional shift in marketing strategy.
Intentional how?
The CEO said they are now deliberately focusing their paid media spend almost exclusively on the 35 to 50-year-old demographic.
Ah, so they're targeting the parents, the actual decision makers who buy the subscriptions.
Exactly. They are sacrificing that broad, maybe low-cost viral MAU growth for high-quality, high-intent MAUs.
So the idea is, while the total number of new free users might slow down a bit, the conversion rate of those users to paid plans should accelerate.
And accelerate within the first 30 days. So they're trading a vanity metric for a profit metric. The LTV to CAC ratio should go up dramatically.
But the market punished them for it. They saw a slowing user growth number and just hit the panic button.
That is the narrative conflict in a nutshell.
Okay, let's move to guidance, because management seemed incredibly confident. They raised their full-year revenue outlook.
Yeah, to between 474 and 485 million.
And more importantly, I think, they significantly raised the adjusted EBITDA guidance.
This is the key. They raised it to a range of $82 to $88 million. If you're worried about margins, this number should have been the immediate answer.
It's management saying, look, our profitability is structurally higher now, and it's sustainable.
It's a huge signal. And alongside that, they launched the Pet GPS tracker.
Which is a brilliant strategic move. It's not just a standalone product.
Not at all. It's a dedicated subscription funnel. You have to have a gold or platinum membership for the device to even work fully.
And they're basically using the hardware as a loss leader, right? They said the gross margin would be negative.
Negative single digits for the rest of the year. They're trading a one-time small loss on a piece of plastic for years of recurring, sticky, high-margin subscription revenue.
It just pulls the household deeper into their ecosystem.
Yeah.
And the early demand was huge. It sold out quickly.
It confirms the thesis. Existing paying customers want this.
Okay, so we have a decisive beat, accelerating cash flow, raised guidance, a smart new product. Why did the stock close down 22%?
One word, Nativo.
The acquisition.
This $120 million deal to buy the ad tech platform Nativo. It just injected a huge amount of risk into the narrative.
I mean, their other revenue, which includes ads, was already growing 82% year over year. The roadmap was working. So why do this now?
Scale. Nativo currently generates roughly double Life360's annual advertising revenue. This is a move to become a major player in that space overnight.
But this is where the margin fear comes in. Life360's core subscription business has, what, a 78% gross margin?
Close to it, yeah. Premium software margins.
So what's the margin profile of an ad tech company like Nativo?
Significantly lower, probably somewhere in the 30% to 50% range. It's structural. Nativo sits across the entire ad tech value chain, managing advertisers and publishers.
So they take on way more cost than just selling their own data.
Precisely. They absorb costs for distribution, verification, the whole tech stack. And when you layer a 40% margin business onto a 78% margin business,
you dilute the company's overall gross margin profile. Okay, I get the fear.
But that brings us back to the guidance.
Right. They just raised the EBITDA guide to over 82 million. Doesn't that mean they already modeled this in? That the total profit picture is still way better than expected?
It does. But the market values different things. Software companies get a premium multiple because of that high 70s gross margin.
So you introduce this complexity, and even if total profit goes up, investors apply a lower blended multiple. They fear the loss of that pure software story.
And suddenly the narrative isn't about margin expansion anymore. It's about margin dilution, execution risk, and potential regulatory risk around location data.
It's perception trumping reality, at least for now. And the stock had been a high flyer, up 62% over the prior year.
So when it stumbled, the fall was exaggerated. You saw that in the trading volume, which was 4 times the average. That's hedge funds and momentum traders all running for the exit at once.
And the analysts were cautious too. They kept their buy ratings,
But almost all of them cut their price targets, flagging that deal-driven execution risk.
So looking ahead, what's the market watching for?
3 things. First, can they integrate Nativo smoothly without messing up the user experience? Second, do the Q4 results actually validate that high-end guidance?
And third, they need to show real data on the Pet GPS, proving it's converting households to higher-tier plans.
The story has just gotten more complex. It's not just about user growth anymore.
Okay, and now we shift gears. We have to be very clear.
Right.
This next part is not financial advice.
We are just running through a speculative contrarian thesis based on this huge divergence between the numbers and the market's reaction. It's purely a thought experiment.
Right. So here's the pitch for a contrarian long position. The thesis is this. The 22% plunge has unfairly punished Life360 for executing a long-term strategy.
You're saying the market panicked about a quality over quantity MAU shift and is now pricing the stock purely on fear of margin dilution.
Exactly. While ignoring the fact that the core subscription engine is healthier than ever, we have record-paying circles, 300+% cash flow growth, and an EBITDA guide that already accounts for Nativo.
So the trade idea is a relative value play.
Precisely. You go long LF at this beaten-down valuation, and you pair it with a short sale on a competitor, a pure-play SaaS company that did not raise its EBITDA guidance.
So you're isolating the bet. You're betting that the market is wrong about the ad mix and has unfairly discounted Life360 relative to its peers.
And if Q4 data shows that the subscription engine is still firing on all cylinders and Nativo is adding to total EBITDA, the market should rapidly re-rate the stock back up.
It's a high-risk bet that financial reality will win out over narrative fear. It hinges completely on that next quarterly report.
It absolutely does.
So as we wrap this up, the central conflict is crystal clear. An amazing operational quarter, completely overridden by strategic controversy.
The market is punishing a company for trying to expand its revenue streams. So the question you have to answer is, does this $120 million Nativo deal represent a huge misstep?
Or is it a deep value buy for a company that's getting closer to becoming that family super app ready to compound growth across multiple vectors?
The outcome really hinges on execution over the next 6 months. It's a fascinating story to watch.
It really is. Thank you for joining us for this deep dive.
We look forward to seeing your analysis.